Ally Financial, stock ticker ALLY, is a financing company that specializes in car financing and online banking. And over the last year, they are down 32% and trading around $31. But they recently released their earnings where they did beat both on the bottom and the top line. So the market responded promptly. And if we take a look closer here, you can see that it actually jumped 20% on Friday. So let's jump into our stock screener to take a closer look at Ally. You can see the PE non-GAAP forward ratio is around 6, which is roughly in line with their historical average over the last 5 years. PB ratio is just under 1, which is something, for example, that Warren Buffett would jump on, and he has also started actually a position in Ally. He did the same when he bought Citi. When we take a look at the dividend yield, is just under 4% right now. Also really nice to see the payout ratio being below 20%. Really, really healthy, I would say. They do have an analyst target price of around the current price. So right now, the analyst doesn't think there's too big of an upside in it. And you can also see the analyst target growth is actually negative for the coming years. If we come down to the preferred metrics I have, I do look at the EPS growth to be over 10%, and it's at 30%. Return on equity being over 15%. It's around 16, so that's also nice. Net debt to EBITDA doesn't really apply for banks. Market leader competitive advantages and low cyclicality. Again, market leader and competitive advantages is in the auto financing. I think they're pretty high for Ally. Low cyclicality. It is a bank stock, so obviously they are affected by the economic cycle. Constructive acquisitions and good capital allocation. I do think they have that. Not the highest level of ownership from the management, but still it's there. Market evaluation, we do have our market valuation spreadsheet, so we are going to jump into those after we're taking a closer look at some of the dividend data. They started paying a dividend in 2016. As mentioned, it's just under 4%, and actually grown it quite a lot over the last many, many years. You can see here we are taking a look at over the last 3 years of 16%. Over the last 5 years, also around 16%. So they are having focus on the dividend a lot, which I really like to see. And if you come down to the dividend yield, you can also see that it could look as if there's a good discount on the stock right now, according to the yield. And as I said, it was in line with the PE for the 5-year average. Also, if we compare it to the return of the S&P 500, it is not outperforming the market. But let's take a closer look at some of our valuation models, where we first do have the Graham's revised valuation model, where we do take the growth rate and the average yield of AAA corporate bond, combined with the current yield of AAA corporate bond, we arrive at an intrinsic value. And in the case here, it's negative 21 because we do have a negative growth rate. So I have omitted this one. The next one is the discounted cash flow model, where we do take the free cash flow from the different years. We do project it into the future. I've applied a growth rate of 0% due to the negative growth they will experience. And the average growth rate is around 1.5 normally. So as you can see here, all of the free cash flows in the future are equal to each other. We then discount that back to a present value, combine that with cash and total debt, arrive at an equity value. Combined with shares outstanding, we arrive at a fair value of 122. That is probably a bit on the high side, but we will take a closer look at that later. The dividend discount model, where we do take the dividend payout from the different years, we do find the growth rate, have an average growth rate and an applied growth rate. We take the growth rate applied together with the weighted average cost of capital to arrive at an intrinsic value of $24 for Ally. The multiple valuation, where we compare it to its peers and their EPS and PE multiples, then we combine that to arrive at a stock price of Ally for around $57. The free cash flow valuation, where we take the price to free cash flow ratio and combine it with the free cash flow per share, we arrive at an intrinsic value of $47 per year. And the last one is the Peter Lynch model, but due to the growth rate being negative, it's not computing anything because it would arrive at a negative intrinsic value as well. So in this case, I've omitted it. If you come so far, please support the channel by subscribing to it or liking the video. That will help me out ever so much. And let's jump into the summary, where you can see I have a small toggle bar here if we should include or not. And as mentioned, both Graham's and Peter Lynch evaluation had negative values, so I have omitted those two. If we arrive at an average intrinsic value of $62, with the current price being $31, we do have an average current discount of around 50%. I would probably go for a really high margin of safety because, as mentioned, this stock has a lot of upside if the circumstances are correct. And in this case, if we do have a soft landing in the recession, there's a massive upside to Ally, I'm sure. But if we do have a harder recession, then people will probably start to default on their auto loans. And in that case, Ally will be hit pretty hard. So at the current levels, using the valuation method I've done, we have a margin of safety of around 50%. It's a bit high. I would probably say that it's still a bit high here in that, and I would probably go for a high margin of safety. But I'm personally long in Ally, and I think that it'll be a pretty good stock for many, many years coming, because they do have a lot of auto financing, a market leader in that, and they also do have a lot going on with their online banking. It's where the young people are, and that is where you want to be if you want to catch them. So thank you so much once again for watching, and I'll see you in the next